Welcome to the Keiser Report. I'm Max Keiser. He's back. Liam Halligan is here for the headlines of the Keiser Report. We needed an insider to delve deep and look at some of the interesting cross currents that occur in this magical place called the mainstream financial press here in the UK. Stacey?
Max, we had to have him back on because, of course, the headlines we're going to cover today involve you. So we need kind of somebody else besides yourself to talk about them. So it starts with this headline from the Financial Times from Martin Wolf, I guess their lead commentator.
Who's Martin Wolf?
Martin Wolf's probably the most important financial commentator at the Financial Times.
Right, he's like the top dog.
Yeah, ex-World Bank, very mainstream writer with a big following around the world.
He's definitely part of the establishment, definitely part of the central banking system.
Obviously,
I don't think he's part of the central banking system.
Well, World Bank is part of that whole
No, he used to work at the World Bank many years ago.
He comes out of that. He comes out of that
before he became a journalist.
So he wrote a piece about radical cures needed for unusual economic ills, which prompted a reply from Max Keiser, which was published in the Financial Times after Martin Wolf gave us permission for them to print it. And it's away with economic quackery. Capitalism requires capital. So obviously you could tell from the title, radical cures needed for unusual economic ills. What are some of his radical cures?
Well, I mean, by radical cures, let's get into this, because what he's suggesting is more central bank intervention and less market of setting of prices, including interest rates. In his letter to me, Stacey, he wrote me a personal letter when I sent the Financial Times that email to be printed. He then wrote to me and said, I'm going to allow that letter to be printed. So he's running, roughshod over their editorial policy right from the beginning here. But then he says basically that I thought in the free market one gets what people are prepared to pay on the margin, X quote. Well, yeah, that's right. So why is he suggesting radical measures of central bank intervention to manipulate interest rates and other forms of market behavior? Why is he against market? He doesn't understand that he is espousing market manipulation.
What we're seeing here is the collision of two worlds, the clash of two cultures. And Martin Wolf and many mainstream economic commentators have backed Western central banks as they've pursued their zero interest rate policy, as they've pursued a massive, almost historically unprecedented expansion of central bank balance sheets. I've been very, very sceptical of that expansion in my Telegraph column since it began in 2009, certainly in the UK and the US. I was also very sceptical of it when the Japanese did it from the early 2000s. And you've been sceptical of it too. But Max, even though an awful lot of people out there in the markets, when they talk privately and so on, back our point of view, we think QE's gone too far. It was a reasonable emergency measure. It's become a lifestyle choice. Very, very few people want to articulate that publicly, and very, very few journalists will articulate it publicly, because, of course, as long as QE keeps going, the markets keep booming, governments can keep borrowing and spending with a rigged sovereign debt market.
Martin Wolf
and it's very convenient for lots of people. And so if you're going to be the kid who points his finger and says the emperor's got no clothes, that's going to make you unpopular.
Yeah, but Martin Wolf is more than just a warped ideologue espousing. He's actually a dangerous extremist because he's wrong on both counts. Not only is he wrong about the way markets work and why the central bank is either going to be in the game or out of the game, he wants the central bank to be manipulating rates to create financial repression, A. But he won't allow central banks to raise rates to get rid of the zombie banks. You see what I'm saying? He's wrong on both counts. You're either for central banks or you're against central banks. You can't be for central banks that are promoting financial terrorism or financial repression on one hand, and then say, well, I don't know, central bank, I don't know how interest rates are set. I have no idea. I'm Martin Wolf. I just have my head in my I have no idea. You have to take one position or other. You can't take the worst of both positions.
No, I agree. A lot of mainstream economic commentary at the moment is warped, and I think future historians will look back and see that. I think it's crazy that we've become addicted to quantitative easing. There's no other way of putting it in the Western world. We've now got Japan trying to out-QE the Western world when Western world has been trying to out QE Japan.
And Japan has just been downgraded.
There's an arms race, in Jim Rickard's phrase, and he's exactly right. There are currency wars going on, where you've got Japan now trying to competitively depreciate against the West.
Okay, Lee Milligan, you were just on recently, and you wrote a brilliant column in the Telegraph talking about the black hole of debt that is the Japanese central bank. Moody's just downgraded them, exactly as they would expect, based on what you were saying. What's your response?
Well, I think it's good that Moody's are actually becoming realistic. For many years, I think the Western credit agencies have extended huge amounts of latitude to the Japanese economy, just as they extend huge latitude to the British and the US economy. There's very little science involved. It seems to me that pretty much all the major Western sovereigns are still AAA or pretty near AAA, when clearly they're in a much, much weaker position, whereas a lot of emerging market sovereigns are BBB or lower when they're in a much, much stronger position. That's why you're getting the Chinese now developing their own ratings agencies, which across Asia are much more respected than our own. I think that's a very, very unfortunate development. So I think it's good that Moody's have done that. Abenomics is clearly the last throw of the dice. He's increasing Japan's central bank's balance sheet from 50% of GDP to 70% of GDP in little more than a year. That really is kamikaze-style economics in a desperate bid to try and make himself popular enough to hold on to power. What he's doing is precisely what independent central banking was invented and designed and won over many, many decades and centuries of economic incompetence to prevent. And yet we're letting it happen again. And my fear is this kind of out of control monetary policy is now coming to your country and to my country here in the UK. We're not that far off.
Stacey, let's get Stacey jumping in.
Let's go back to the headline, radical cures needed for unusual economic ills. Are these even unusual economic ills? That we keep on being told that this is unusual times.
I think we've made them unusual. My whole premise over many years has been that when people look back on this period, it won't be that we got into a hole in 2008. Gee, we always do. We're human after all. It's the constant struggle between fear and greed. What will really make future historians wince about this age, Stacey, is that our response to the subprime crisis was so massively disproportionate, forgetting so many of the historic lessons we thought we knew. Suddenly, the whole of the Western policy-making establishment became ultra-Keynesian. Suddenly, the whole of the Western policy-making establishment became Japanese, with huge demand, with huge increases in government spending and government borrowing, despite even veiled in many ways by austerity rhetoric, and unprecedented peacetime expansions in bank balance sheets. And what was it for? It was to allow governments to keep spending, and it was to shield the fact that we had a lot of insolvent banks that needed to be restructured, merged with more solvent banks.
This is Keynesian.
That's politically very difficult.
This is Keynesian, the sound of one hand clapping. Because when the markets are in needing of a central bank buffer, they step in. But then when markets rally, they step in again.
That's right.
They never take the punch bowl away, Stacey.
But also, these radical cures have also caused something that is quite unique right now, in that I was looking at a chart earlier this week where they showed the S&P 500 and the price of oil, and they always go together. They go up and down together. Now there's a complete historic disconnect that oil is collapsing. Copper, gold, silver are all acting like the real economy is collapsing and that there's a major deflationary spiral very similar to 2008. And yet these equity markets, like all the price signals, which are supposed to be like the raw ingredients of capitalism, are gone.
But QE doesn't increase the broad money supply and address deflation. QE increases the size of the central bank's balance sheet, the monetary base, if you like, without getting really, really technical and spending this whole
program on discussions. And as we were saying before, it's causing deflation, not fighting deflation.
You have to have bank lending in order to turn that monetary base into, the fuel of real economic activity and investment. And we haven't got that. Keynes had a brilliant, brilliant phrase for it, and he was far better wordsmith than he was an economist. And what he said is that trying to grow an economy by increasing the monetary base is like trying to grow fat by buying a bigger belt.
Yeah.
Stacey.
Exactly. But you're talking about the bank lending required. It only goes to lending to buy houses or properties, or lending on margin to buy more stocks.
The lending that we've seen has been extremely low compared to the size of the economy. We've had constant contractions in bank lending across the Western world, and what lending there has been, you're right, has been to real estate and to other financial institutions to allow them to get a levered up bigger piece of the increase in asset markets prices which the QE is causing.
And let's be nice to Martin Wolf.
Why?
Yeah, let's be fair.
Why?
Well, he does say one thing that is true, and he condemns the knee-jerk reaction from labor market reform, which always entails lowering wages for a large proportion of the labor force and making it easier for employers to hire and fire, which is the exact opposite of what we need now. We need higher wages. Real wages have declined, and the debt levels have not.
I mean, what I'd say is that Martin's position is not unusual among the sort of panoply of mainstream financial commentators in the UK or indeed across the Western world. He just happens to have a particularly prominent perch. And I'd also say I think it's actually a watershed, Max. Congratulations for writing a precedent letter to the FT. Congratulations to the FT for running it as their lead letter. I mean, this is a big deal. They're not only taking you seriously, they're giving you the lead slot, the coveted lead slot in the letters page.
I want to
I think that's
emphasize
good
the
on both
point,
sides.
but I want to emphasize the
and
point.
we need Martin on this show so he can defend himself.
Wait, but this is when he suggests radical measures. He's a radical and he's an extremist when it comes to monetary policy and economics, and people don't understand that in the
because
field
the
of
mainstream view is now extreme.
I know.
I agree
That's
with
why.
that.
But look, if I say Martin Wolf is the Taliban of the FT, the Taliban of financial policies, I'm not saying that to be glib. I sincerely believe, as I've said many times, he's a financial terrorist. And this man is a leader. He's a leader. Martin Wolf. He says it right here. I'm an extremist. I'm a radical. So where are the authorities? Where's the Serious Fraud Office? Where's all the regulators? They're nowhere to be found. And it's right in their midst. It's right there down the street, the big black FT building. Where are they? They want to arrest this man.
I think you're saying that because he did call you a Luddite, right? For saying that.
And that hurt. That hurt, Max.
No, well, I mean, he obviously has no idea who I am.
Techno-computer programming expert to be called
I
a Luddite.
invented trading technologies. I have patents on those technologies.
Oh,
if
that
he did
really
any research
hurt.
whatsoever,
That really
so just
hurt.
pulling nonsense out of his he would have known who he's talking to. This man is a menace to society, as bad as Osborne, as bad as Cameron.
But they publish your letter.
They
Which
did
is
publish-
progress.
Well, the FT is...
Yeah, the mainstream publishing Max Keiser in their lead letters page.
Anyway, the point is Japan has been doing radical cures for unusual economic ills for the past 30 years. We see where it leads.
All right, fair enough.
I got the last word.
All right, we'll stay tuned for the second half. A whole lot more? Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Chris Powell of GATA, the Gold Antitrust Action Committee. Chris, welcome back to the Keiser Report.
Thrilled to be here, Max. Thank you.
All right, so of course, as always, we're talking about gold, silver. Let's talk about what's going on in Switzerland recently. The gold initiative was rejected by about 78% of the voters. So this was an idea that the voters were put forward, that they wanted to back the Swiss currency in part with gold. They rejected it. What do you make of all this?
Well, I suspect that the voters bought the argument that the initiative was a little too restrictive of the central bank, though I applaud its supporters for raising the whole issue of currency depreciation and market manipulation, which really is at the, I think, the heart of the initiative. The Swiss are in a difficult situation. The whole world is in a difficult situation with all the currencies depreciating and the central banks rigging the markets.
Yeah, the issue of gold is in a funny quandary because the demand for gold is quite high. And yet we see prices weaken, whereas the supply of government bonds is increasing by trillions of dollars worth, and yet the price goes up. So a complete repudiation of the entire idea of supply and demand. To give you an example of this, just recently the Netherlands surprised everyone by announcing that they repatriated 122 tons of gold. So here's a country that is anxious to get their hands on gold. I think it was held in the New York Fed, if I'm not mistaken. So along with Switzerland, there seems to be something happening in the Netherlands. What's the Netherlands? What are they thinking?
The Netherlands seems to have joined the clamor for gold repatriation, which kind of began in Germany, except unlike the Germans, the Netherlands seems to be getting its gold back.
Why did Netherlands be able to get their gold back and Germany was told you have to wait 7 years?
Well, exactly what the Germans were told I don't think is known, but I think the difference, Max, is that the Bundesbank does not want its gold back as much as the Netherlands did. Deutsche Bank put out a report saying that there were political difficulties with the Bundesbank's request to repatriate the gold.
Because Deutsche Bank, which is the #1 bank in Germany, of course, is a derivatives powerhouse along with JP Morgan. They have 90 or 100 trillion worth of derivatives. It's all based on paper. And so the idea of having gold circulating for real in the economy must scare the bejesus out of a Deutsche Bank or a JP Morgan, right?
The Tocqueville Gold Fund's manager, John Hathaway, wrote the other day that the derivatives positions of Deutsche Bank are many times larger than the German economy and even a few times larger than the whole European economy. So I've always figured that Deutsche Bank was pretty much an agency of the of the German government, just as Morgan Chase is an agency of the U.S. government.
So let's talk about how crazy this market is. In the gold market, you have the so-called the GOFO rates that even Deutsche Bank is noting are quite unusual. So first of all, what are the GOFO rates for the viewers, and explain a little bit what's going on there?
It's the interest rate you can get for lending or borrowing gold, and in this case, when they're negative, people are paying you to lend gold. Usually, people lend gold against dollars and pay an interest rate on the dollars. This indicates that gold is in more demand than the dollars. There's a few explanations for it. The commonest explanation for it is that gold is in very short supply, and that certain financial institutions are willing to pay to borrow it to presumably apply it to places where it's overdue. Now, I don't know that that's always the case. Brian Sachecki of the Perth Mint wrote today, it may be just that there's a great eagerness among certain people to short gold, and they're borrowing it to short it in the hope of the price going down. But it's very unusual, and I think the main conclusion people draw is that it indicates a scarcity.
Yeah, so you have a 1-month GOFO rate, as you say, is negative. It's been a negative on a few occasions in the past. But now the 1-year GOFO rate is close to going negative, which would be the first time ever. So to follow up on what you're just saying there, either there's a shortage of gold, or you're indicating that people are so anxious to short gold and get their hands on it to sell it, they're willing to pay the interest rate spread, presumably. They're still making money on their short sales, even in a leveraged position, right?
Well, possibly. It could also be central bank activity. I mean, central banks create infinite money. They issue currencies that compete with gold as the international currency. I think shorting gold has always been the loss leader for central banks. They may lose money on their gold trading, but they make it up on their currencies and bonds. Now, that's really just speculation on my part, but my organization does collect and compile and publish documentation about the constant intervention of the gold market by central banks, and I think that suggests that they're willing to lose some money. They're willing to be embarrassed, if necessary, to keep the gold price down.
Because central banks and the banking system make their money selling bonds and feeding into that paper market. So if the price of gold goes up, people would say, maybe I should shift some funds out of my paper, out of my bonds, into gold. And then, so what you're saying is they're willing to take potentially a little bit of risk in the gold market to keep that paper Ponzi scheme alive and well and growing.
Absolutely. I mean, gold is really just a small part of central bank assets. Central banks are far more invested, as you note, in currencies and bonds, but gold is their competitor. Gold, as a matter of fact, is a determinant of currency values and interest rates. There's academic literature on this point. Part of it was written by Lawrence Summers when he was economics professor at Harvard before he became Deputy Treasury Secretary and then Treasury Secretary of the United States. Gold is a determinant of interest rates and currency values, and central banks have always considered it their deadly enemy, and they figure that either they're going to control gold or gold is going to control them, gold really representing free markets.
Now, Chris Powell, Gold Antitrust Action Committee, GATA, which you are a member, they've been saying now for 10 years that gold and silver are manipulated, and during that period of time, evidence has come out in silver and now gold, that gold, in fact, is being manipulated. This is now it's no longer an open secret, it's just a plain fact. The banks admit it, the central banks admit it, no one questions this anymore. And like LIBOR, like Forex, like the energy markets, gold is now in that category of openly manipulated markets to benefit those who are benefiting from these massive manipulative schemes. But the press hasn't really followed through with much coverage, and the public doesn't seem to give it much credence. The only way, or attention, the only way the public would seem to care about this is if they had the perception that gold had value. But the mainstream media is very good at projecting this image that gold has no value. We shouldn't care because gold is worthless.
No, the mainstream financial press, Max, is always vigorously propagandizing against gold. You know, the investment banks have been shown to have manipulated the gold market, but central banks have not really made any public admissions. You can find admissions if you go through the archives, if you read speeches that they give to each other when, you know, they don't think the public is watching. But the central banks have not been forced into admissions that I think they would have to make if we had a real financial press on this planet. And part of my purpose in London is to try to persuade mainstream financial news organizations to put some crucial, specific questions to central banks about their activity in the gold market, about their gold swaps and leases, about the sales of futures and options that they undertake through the Bank for International Settlements, about the records of the International Monetary Fund, which show that central banks undertake gold swaps and leases precisely so that they can rig the currency markets in secret.
But wait a minute, let me jump in here for a second, because the New York Fed, where a lot of gold is for the world, they're not delivering gold that's been asked of them to be delivered, and that's the same as failure to deliver on a short sale. In other words, there's a huge number of short sales around the world in the gold market, forcing that price down. You know, paper sales of more gold than there is mined, more gold than there is in existence. We see sales of more gold than there's ever been conceived of in the history of man. There's still paper sales. So those short sales need to have delivery of the commodity, of the other side of the trade, and the Fed's not delivering. That's open manipulation. The Fed is openly manipulating this market by failing to deliver the gold against these short sales.
Insofar as the Germans are unable to get their gold back, it does suggest that the custodial goal at the New York Fed is, to put it politely, oversubscribed.
Yeah, it does suggest it, and more than just a suggestion. Give Deutsche Bank, we just said, is the top derivatives trader in the world, and Germany asked for gold to be delivered because the German people want their 3,000 tons of gold. After we did a report 4 or 5 years ago, went to the Bundesbank in Frankfurt, and they said, we don't have the gold. This was a revelation. This set off a chain reaction. Oh, we want our gold. Now they want their gold. They're saying, no, you can't have the gold. The Dutch can have their gold because, you know, for whatever reason, but the Germans know, because Deutsche Bank, the chief derivatives trader, it would settle these contracts and give a fair market price for gold. They don't want a fair market price for gold.
No, I remember your interview with the Bundesbank and about the location of the German gold, and that was quite a revelation at the time. And in fact, I think that kind of kicked off the German gold repatriation.
It kicked off the global gold repatriation movement. And not only that, but here on RT, I got to say, the Russians have been mad buyers of gold. We've been talking about this for years. Russia. Let's talk about Russia for a second. They have been, along with China, accumulating gold. They're on the other side of this trade. What does that tell you, Chris?
I think it tells me that the Russians know that the West has built its financial system on a vast fractional reserve gold banking system that is fraudulent. Back in 2004, the deputy chairman of the Bank of Russia, Oleg Mazayskov, gave the keynote speech to the London Bullion Market Association meeting at the Kempinski Hotel in Moscow. The only words in English he spoke were Gold Antitrust Action Committee. Now, to our knowledge, we'd never had any contact with anyone in Russia prior to that point. Somehow the Russians were onto our work. They have figured out.
They watch my show. What do you
Well,
think? It's on freaking RT. You don't think they watch the show?
They have figured out that there's this fractional reserve gold banking system where there may be 100 claims on every ounce of gold that the West purports to have. And I think the Russians, the Chinese, certain other investors in central banks are gradually trying to withdraw gold and without crashing the system.
All right, hold on a second, Chris, because we're out of time. We're going to have you on for another segment, if you can do that with us.
Of course.
And we're going to talk currency wars, geopolitical currency wars. So, it's going to be hot stuff, all right? So sit right there. And that's going to do it for this episode of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Chris Powell of GATTA, the Gold Antitrust Action Committee. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.